So today, we're going to pull back the curtain on the engine of the global economy, the US stock market. We're going to dive into its, well, pretty surprising origins, break down how it actually works day to day, and figure out what all its ups and downs really mean for us. Ready? Let's get into it. You'll often hear it called the beating heart of global finance. And honestly, that's for a really good reason. A single decision made on Wall Street can literally send ripples across the entire world economy in just a matter of seconds. The sheer scale of it all, it's almost hard to wrap your head around. And when I say the scale is huge, I mean, it is staggering. We are talking about a market capitalization, which is just the total value of every share of every company listed, of over $50 trillion. To put it simply, this is by a huge margin the largest and most influential financial market on the entire planet. Okay, so who are the main players in this massive system? Well, it's pretty much dominated by two giants, the New York Stock Exchange, or NYSE, and the NASDAQ. And as you're about to see, they basically come from completely different worlds. It all kicked off way back in 1792. Imagine this, a group of 24 brokers met up under a Buttonwood Tree on Wall Street. They were just trying to create a more organized way to trade. Well, that little agreement they signed became the foundation for the New York Stock Exchange. Now, fast forward nearly 180 years to 1971, and boom, a technological revolution happens. NASDAQ launches, and it's the world's very first fully electronic stock market. And this is where you really see their distinct personalities. You've got the NYSE on the left, which became the home for all those established blue-chip companies. The huge, stable corporations like Coca-Cola. It's famous for that historic, chaotic, physical trading floor. Then on the right, you have NASDAQ. It was built for the modern era. It is the go-to exchange for all the innovative tech and high-growth companies like Apple and Microsoft, and it has been completely electronic from day one. So, we've met the major exchanges. But what is actually happening there every single day? How do billions of shares just seamlessly change hands? Let's break it all down. Okay, so at its absolute core, the stock exchange works just like a giant auction house. Companies offer up tiny pieces of ownership, we call them shares, to raise money to grow their business. In return, investors like us buy those shares, basically betting that the company is going to do well and that the value of our little piece of ownership will go up. Now, this marketplace has a few key players. First, there are retail investors. Hey, that's you and me. Then you have the institutional investors. These are the heavyweights. Think pension funds managing retirement money or huge hedge funds. They trade in absolutely massive volumes. Then you have market makers who are super important. They're always ready to buy or sell, which provides liquidity and makes sure trades can happen instantly. And of course, watching over all of it, you have regulators like the SEC. They're the referees making sure the game is fair. So with billions, literally billions of shares trading all the time, it would be completely impossible to track everything. So how do we get a quick snapshot of how the market is doing? Well, that's where indices come in. This is where the big three come into play. The Dow Jones is the oldest one. It only tracks 30 large industrial-type companies, so it's more of a historical snapshot. The NASDAQ Composite? Well, that's our window into the tech world. It's heavily focused on innovation and growth stocks. But the one that most of the professionals really watch is the S&P 500. It tracks 500 of the largest U.S. companies across every major sector of the economy. And that right there is the crucial point. Because it's so broad and so diverse, the S&P 500 is pretty much seen as the best single report card for the health of the entire U.S. economy. So next time you hear on the news that the market is up or down, chances are they're actually talking about the S&P 500. Okay, so understanding the market's mechanics is one thing, but I'm sure that brings up the big question. So what does this all mean for me? How should I interact with it? Let's shift gears and talk about how to approach this world responsibly. For most people, the journey doesn't actually start with trying to pick the next big stock. A really common first step, and a smart one, is to build a solid financial foundation. That means an emergency fund that can cover a few months of your expenses. From there, a popular approach for beginners is to invest in broad, low-cost funds that just mirror an entire index, like the S&P 500. This whole strategy is built on a really important mindset, focusing on long-term growth over decades, not trying to make a quick buck over a few days. It's funny, because the biggest risk in the market isn't always some big crash. A lot of the time, the biggest enemy is our own psychology. It really comes down to this idea. Our emotions can be our own worst enemy. Fear can drive us to sell everything at the very bottom, locking in our losses. And then greed tempts us to buy at the very top, right before things might take a turn.
Which really leads us to one final crucial question. In a world that is completely dominated by high-speed trading and a 24/7 news cycle, could it be that the most powerful tool any of us has is simply patience? It's definitely something to think about as you navigate this complex financial world. Thanks so much for joining this explainer.